we've got a lot to talk about, Derek, in terms of the markets. And I think one of the strange themes from the past week was falling 10-year interest rates, the 10-year Treasury dropping briefly down to as low as 1.25%. That's right, falling interest rates. I don't think anybody thought in July of 2021 that would be the discussion.
No, in fact, we got as low as 1.25% this week. It's in some ways, it's very similar to what happened with the stock market last year, where the U.S. economy continued to regress, go down in a recessionary sort of situation as the pandemic took hold, yet the stock market rallied. Now we have a bond market where the interest rates continue to move lower, despite the fact that the Atlanta Fed is looking for 8% GDP growth in Q2, and we're expecting 65% plus earnings growth in the S&P 500 for the second quarter.
And all signs seem to think that we've got this really strong growth environment, but we do need to pan out a little and look a little bit more globally, because there are some indications that perhaps growth is starting to slow in certain areas.
And that's really what it is, I think. Overseas interest rates are not as attractive as they are in the United States. For example, in Germany, a 10-year Bund is at negative yields. The UK 10-year is trading just above zero. So that 1.3% looks juicy to a foreign investor in some ways. The other thing that's happened, too, is central banks overseas are becoming more aggressive. The ECB has said they're going to allow their economy to run hot. They have pushed interest rates to extremely low levels, but economic growth there has been languishing as they've had more difficulty dealing with the virus. In China, they signaled that more central bank easing is coming. So all of that has a downward effect on interest rates. And let's not forget that the Fed, in their FOMC minutes, said that there is substantial further progress to go, and that's in terms of the labor market. So they're going to remain accommodative, and they continue to buy treasuries, which helps keep those rates low.
And I think when we all look around and see all the help wanted signs out there, it just seems like it's a bit disconnected. But that's our view here, in the U.S. And when you look at some of those things, including, the variant of the COVID virus, that is taking hold in certain areas, that you might see, continued lockdowns, and that certainly would be a drag on economic growth.
It would. And we are long overdue for a correction. The S&P 500 touched a new all-time high on Friday, had a nice rebound from a very weak day on Thursday. But generally speaking, what I think investors need to think about is what is going to be the catalyst to drive equity prices higher in the second half. We saw a 15% return for the S&P in the first half. Small caps did even better, up 23%. Those are tremendous years, particularly when you follow what we saw in 2020. So we really need a catalyst in order to generate the kind of enthusiasm that will cause people to continue to buy stocks, which they certainly have started to, as we've seen significant inflows into ETFs and mutual funds.
And trees don't grow to the sky. You started out with your thoughts that, we haven't seen a correction in quite some time. And, I think that the caution for people is, we had this great first half of the year that doesn't translate to, a mirror image of that for the second half of the year.
And what it also translates to is if you own small caps in your portfolio and you own large caps in your portfolio, those allocations are probably above your target levels because they outperformed the more conservative aspects to your portfolio. So it's a good time to take a look at that and potentially rebalance and get back to your target risk level.
I think you're right about that. Inflation, I think, is that topic that everybody's been talking about. And, the European Central Bank, sort of reiterated the policy that the Fed put in place a while ago, which was to look for more of an average inflation rate over time. And so what that means is if we've got a period of low inflation, they will allow a period of high inflation. So European Central Bank on board with that thought.
And inflation is really in the eye of the beholder. Some could say that the increase in the S&P 500 since March of 2020 is a measure of inflation. The Fed doesn't seem to think that way. They're looking at wage growth. They're looking at, some of these components like rent and the rest and how that's going to affect the PCE, which is the inflation indicator they look at. But they continue to believe that the spike in inflation that we saw last month in particular, was an aberration. We're going to get CPI next week. We're going to get retail sales next week. So we'll get a new read on CPI. But just remember, the government has an incentive to understate CPI, since so much of the expenses that they face are priced in those terms.